Something is happening inside the Federal Reserve right now that creates a contradiction so profound that almost nobody is connecting the pieces. And the reason nobody is connecting them is because doing so would reveal that the comfortable narrative about rate cuts coming to save the economy might be built on assumptions that history says are completely wrong. Let me show you what I mean, because the next 90 days could determine the trajectory of interest rates for the rest of the year, and the data is pointing in two completely opposite directions simultaneously. For months, futures markets have priced in just 2 quarter percentage point rate cuts from the Federal Reserve in 2026. That was the baseline expectation. The Fed would cut twice, bringing the Fed funds rate down by 0.5% over the course of the year. Mortgage rates would ease modestly. Borrowing costs would decline gradually. The economy would get a slight tailwind. That was the story everyone believed. But in the past month, something changed dramatically. The probability of 3 or more rate cuts in 2026 has surged to 43%. That is up from 25.6% just 1 month ago. In 30 days, the odds of additional cuts nearly doubled. That is not a minor shift in expectations. That is a fundamental repricing of what the Federal Reserve is going to do this year. And the catalyst for that repricing is data that came in better than expected. Consumer prices rose 2.4% on an annual basis in January. Economists had expected 2.5%. That 0.1% difference might sound trivial, but in monetary policy, 0.1% matter enormously. More importantly, core CPI, which strips out volatile food and energy prices, came in at 2.5%. That is the lowest level since April 2021. Nearly 5 years. For nearly 5 years, core inflation has not been this low. And that changes everything about the Federal Reserve's room to maneuver. Austan Goolsbee, president of the Federal Reserve Bank of Chicago, said something this week that markets heard loud and clear. He said, if the path to 2% continues, I still think there are several more rate cuts that can happen in 2026. Several. Not 2. Several. That is a sitting Federal Reserve Bank president telling markets that 3, 4, maybe even more rate cuts are possible if inflation keeps falling. And here is what makes that statement significant. Fed officials are famously cautious about predicting rates. They hedge every statement. They qualify every forecast. They never want to box themselves in. When Goolsbee says several more cuts are possible, he is signaling that the internal discussion at the Fed has shifted. The doves are gaining ground. The case for cutting is strengthening. The data is giving the Fed exactly what it needed to justify moving rates lower. But before you get too comfortable with that narrative, let me show you the other side of this story. Because there is a historical pattern that nobody is talking about that suggests the exact opposite could happen. And this pattern has repeated with remarkable consistency for over 70 years. Jerome Powell's term as Federal Reserve Chair ends on May 15, 2026. Between now and then, he will preside over exactly 2 more rate-setting committee meetings, March 18th and April 29th. After that, his tenure ends and Kevin Warsh, President Trump's nominee, takes over. Powell is a lame duck. Everyone knows it. He knows it, the markets know it, the other Fed officials know it, and lame duck Fed chairs behave differently than Fed chairs who expect to remain in their positions. I analyzed the historical record of every Fed chair since 1951, looking at what happened to the Fed funds rate in the final 3, 6, and 12 months of their tenures, and the pattern is striking. In almost every case, interest rates increased during the lame duck period, not decreased, increased. In the few instances where rates fell during a Fed chair's final months, the decline was tiny, barely measurable. This pattern contradicts everything the market is currently pricing. The CME FedWatch tool gives a 78.5% probability that the Fed funds rate will be unchanged when Powell steps down. It gives a 21.5% probability that rates will be lower, and it gives 0% odds, literally 0, that rates will be higher. The market sees no possibility whatsoever of a rate hike before May. But the historical record says the market is wrong. The probability of higher rates, while perhaps small, is greater than 0. And here is the critical point. The minutes from the January FOMC meeting, released just this week, revealed that some Fed officials are actively entertaining the prospect of rate hikes, not cuts. Hikes. The market is pricing 0 probability. The Fed itself is discussing the possibility. That gap between market expectations and Fed deliberations is where financial surprises happen. Why would a lame duck Fed chair lean toward higher rates rather than lower? There are 2 compelling explanations. First, being a lame duck insulates a Fed chair from political pressure. When you know your time in office is done, when there is no possibility of renomination, you stop worrying about pleasing the White House. You focus instead on your legacy. And for a central banker, the most important legacy is being remembered as an inflation fighter. A Fed chair who cuts rates during a lame duck period and then watches inflation spike after they leave looks like a failure. A Fed chair who holds rates steady or even raises them, ensuring inflation stays under control, looks like a responsible steward of monetary policy. The incentive structure points toward hawkishness, not dovishness. Second, Powell might be deliberately leaving room for his successor. If Powell cuts rates in his final months, Kevin Warsh inherits a lower starting point with less room to maneuver. If Powell holds rates steady, Warsh gets to be the one who delivers rate cuts, earning the political goodwill that comes with easing monetary policy. By not cutting, Powell gives Warsh a gift, and in exchange, Powell avoids being blamed if those cuts turn out to be premature. Notice that both explanations point in the same direction, away from rate cuts before May. The 43% probability of 3 or more cuts this year assumes those cuts happen, but if Powell does not cut in March or April, which the historical pattern suggests he will not, then the entire cutting cycle gets pushed to the second half of the year under Warsh's leadership, and that changes the timing, the magnitude, and the economic impact of whatever easing eventually occurs. Now let me show you the Kevin Warsh complication because his policy goals create a contradiction that nobody is fully explaining. Warsh wants to cut the Fed's target rate. That much is clear. President Trump would not have nominated him otherwise. Trump explicitly said he would not have given Warsh the job if Warsh wanted to raise rates. So rate cuts under Warsh are virtually guaranteed. But Warsh also wants to shrink the Federal Reserve's massive balance sheet. The Fed currently holds trillions of dollars in treasury bonds and mortgage-backed securities, accumulated during years of quantitative easing. Reducing that balance sheet, selling those assets back into the market, has the effect of tightening financial conditions. It pushes bond yields higher. It reduces liquidity in the banking system. It makes borrowing more expensive. So Warsh wants to cut rates, which eases financial conditions, while simultaneously shrinking the balance sheet, which tightens financial conditions. These are opposing forces. The net effect on overall borrowing costs is genuinely uncertain. You could have a situation where the Fed cuts the Fed funds rate by 75 basis points over the course of the year, but balance sheet reduction pushes mortgage rates and corporate borrowing costs higher anyway. You could have rate cuts that deliver no relief to consumers and businesses because the balance sheet effect offsets the rate effect. This is not a theoretical concern. This is a real-world consequence of contradictory policy goals that will play out in the interest rates you pay on your mortgage, your car loan, your credit card, and your business financing. And there is a deeper problem. Markets do not know how to price this combination. For years, the Fed has either been cutting rates while expanding the balance sheet, which is unambiguously stimulative, or raising rates while shrinking the balance sheet, which is unambiguously restrictive. Warsh is proposing to cut rates while shrinking the balance sheet, which is neither clearly stimulative nor clearly restrictive. It creates uncertainty about the direction of monetary policy, even while specific policy actions are being taken. And uncertainty, more than any specific rate level, is what damages economic planning and financial decision-making. Let me show you why all of this matters for your life, because the abstract debate about Fed policy becomes very concrete when it affects your household budget and your financial security. Rate cuts matter enormously to financial markets. When the Fed cuts rates, stocks almost inevitably get a boost. Expectations of easier borrowing create optimism that companies can reduce their interest expenses and borrow more to expand. More favorable financing for consumers boosts their spending. Corporate earnings improve. Economic activity accelerates. All of that is reflected in higher stock prices. If you have a retirement account, which most Americans do, rate cuts directly affect the value of your portfolio. A Fed that cuts 3 or 4 times this year versus a Fed that cuts only twice represents a significant difference in stock market performance. The difference could easily be 5 to 10% in total returns over the course of the year. On a $500,000 retirement portfolio, that is $25,000 to $50,000 in additional wealth or lost opportunity depending on which scenario plays out. If you have a mortgage or are planning to buy a home, rate cuts determine whether housing becomes more affordable or remains out of reach. The 30-year mortgage rate is influenced by Treasury yields, which are influenced by Fed policy. A Fed that cuts aggressively would likely bring mortgage rates from current levels around 6.5% down toward 5.5 or 6%. On a $400,000 mortgage, that is a difference of approximately $250 per month in your payment. Over 30 years, that is $90,000 in total interest savings. But if the Warsh combination of rate cuts and balance sheet reduction keeps mortgage rates elevated despite lower Fed funds rates, you get neither the rate cut benefit nor the affordability relief you were counting on. If you carry credit card debt, rate cuts reduce your interest charges. The average credit card rate is currently above 20%. Each quarter-point cut from the Fed reduces that by roughly 25 basis points. 3 cuts would bring your rate down by 0.75%. On $10,000 in credit card debt, that saves you approximately $75 per year in interest. Not transformative, but meaningful if you are struggling to pay down balances. If you run a small business, rate cuts reduce your borrowing costs for expansion, inventory financing, and working capital. Lower rates make projects viable that would not pencil out at higher borrowing costs. They make hiring more affordable. They make investment more attractive. The difference between 2 cuts and 4 cuts over the course of a year could be the difference between expanding your business or staying stagnant. But here is the critical point. All of these benefits depend on the cuts actually happening, and the timing matters as much as the magnitude. If Powell does not cut in his remaining 2 meetings, you wait until Warsh takes over in mid-May, at the earliest. If Warsh faces the same inflationary pressures that kept Powell cautious, you wait even longer. If the combination of rate cuts and balance sheet reduction produces unexpected effects on long-term borrowing costs, the relief you expected never materializes in the form you expected. The market is pricing 43% odds of 3 or more cuts. That means there is a 57% chance of fewer than 3 cuts. The most likely scenario, according to the same futures markets, is still 2 cuts or fewer. The optimism about additional cuts is growing, but it has not become the baseline expectation, and even that 43% probability assumes cuts happen under Warsh's leadership in the second half of the year, not under Powell's leadership in the next 90 days. Now let me show you the inflation picture because this is where the case for cuts gets complicated. The January CPI data was encouraging, 2.4% headline inflation, 2.5% core, both below expectations, both moving toward the Fed's 2% target. If this trend continues, rate cuts become easy to justify. But inflation does not always move in straight lines. We have seen this movie before. In late 2023 and early 2024, inflation appeared to be falling steadily toward target. Markets priced in aggressive rate cuts. Then inflation stabilized above 3% and stayed there for months. The expected cuts never materialized. Those who positioned for rate relief got burned. The Fed has been waiting for inflation to close in on its 2% target. The January data is progress, but it is 1 month. The Fed will want to see confirmation. February data, March data, a pattern, not a single data point. And even if the pattern confirms, there is the complication of tariff-related price increases. The tariff situation has been chaotic. Supreme Court rulings, executive order replacements, new 10% global tariffs. The inflationary impact of all this is genuinely uncertain. So far, tariff-related price increases have been modest, mostly confined to some goods categories, but that could change. A supply shock, a retaliatory action from trading partners, an escalation in trade tensions, any of these could push goods prices higher and offset the progress on services inflation. And services inflation is the sticky component that the Fed worries about most. Goods prices can move quickly in either direction based on supply chain factors and trade policy. Services prices, which depend on labor costs, are much harder to bring down. Wage growth is still running near 4%. That puts a floor under services inflation that will not break until the labor market softens. And the labor market has not softened. Unemployment is 4.3% and stable. So the inflation picture is encouraging but not conclusive. 1 good month does not guarantee a trend. And the factors that could reverse progress, tariffs, labor costs, supply shocks, are all present in the current environment. The Fed knows this. That is why, even as some officials talk about several more cuts, others are actively discussing rate hikes. The committee is divided because the data supports multiple interpretations. Let me show you what the financial industry is saying because the institutions that manage trillions of dollars are taking positions based on their assessment of where this goes. Citigroup just disclosed a new risk factor related to interest rate volatility. They warned that changes in benchmark interest rates are likely to materially influence their net interest income because asset yields and funding costs may reprice at different speeds and magnitudes. They specifically cited prolonged low or rapidly falling rates, yield curve flattening or inversion, and rate-driven shifts in depositor and borrower behavior as risks that could compress margins and adversely affect results. What does that mean in plain language? Citigroup is warning its investors that rapid rate cuts could actually hurt bank profitability. When rates fall quickly, banks earn less on their loans before they can reduce what they pay on deposits. The margin between what they earn and what they pay compresses. Profitability suffers, and bank stock prices fall. This is the opposite of what most people assume. Most people assume rate cuts are good for financial institutions. In the short term, rapid cuts can actually damage bank earnings. And if bank earnings suffer, credit availability tightens, which slows the very economic activity that rate cuts are supposed to stimulate. Bloomberg reported that Kevin Warsh might face a prolonged wait before implementing the rate cuts that Trump is advocating for. Inflationary pressures continue to influence the central bank's decision-making process, potentially delaying any immediate monetary policy changes. Even the incoming Fed chair, who was specifically selected because he supports lower rates, may not be able to deliver cuts immediately because the data does not support them. The growing optimism about 3 or more cuts is real. The 43% probability is up significantly from a month ago, but optimism is not certainty, and the gap between market hopes and Fed constraints is where disappointment happens. The Fed will cut when the data supports cutting. If inflation continues falling toward 2%, if the labor market softens, if economic growth slows enough to justify stimulus, cuts will come. But if inflation stabilizes above target, if employment stays strong, if growth remains resilient, the cuts everyone is counting on get delayed. And then there is the wild card of the Fed chair transition itself. The historical pattern of rising rates during lame duck periods is not a guarantee, but it is a warning. Powell has already bucked the averages by cutting 3 times over the past year. His lame duck behavior will be an outlier regardless of what happens next. But the incentives facing a departing Fed chair point toward caution, not aggression, toward protecting a legacy as an inflation fighter, not risking it for a few additional cuts that Warsh could deliver anyway. The CME FedWatch tool gives 0% odds of a rate hike before May. 0. The market sees it as impossible. But the January FOMC minutes say some officials are actively entertaining that prospect. The market is wrong about something. Either the officials discussing hikes are isolated voices who will be overruled, or the market is underestimating the possibility of a hawkish surprise. I am not predicting a rate hike. The most likely outcome is still that Powell holds rates steady through his remaining 2 meetings and hands off to Warsh at the current 3.5 to 3.75% level. But the possibility of a surprise in either direction is higher than the market acknowledges. And surprises move markets violently because positions are not prepared for them. Let me bring all of this together because the next 90 days represent one of the most uncertain periods for monetary policy in recent memory. You have inflation data that is encouraging but not conclusive. You have a Fed chair in his final months whose historical predecessors leaned hawkish rather than dovish. You have an incoming Fed chair whose policy combination of rate cuts plus balance sheet reduction creates genuinely uncertain effects. You have market expectations shifting rapidly, with 43% odds of 3 or more cuts up from 25% a month ago. You have some Fed officials talking about several more cuts while others discuss rate hikes. And you have a president demanding lower rates from a central bank that is supposed to be independent. Every one of these factors pushes in a different direction. The inflation data pushes toward more cuts. The lame duck dynamics push toward holding steady. The Warsh nomination pushes toward eventual cuts, but with uncertain timing and uncertain net effects. The divided FOMC pushes toward paralysis and caution. The political pressure pushes toward accommodation, regardless of what the data says. The outcome depends on which forces dominate, and right now, nobody knows. The market is guessing. The Fed is debating internally. The incoming chair is preparing to take over but has not yet revealed exactly how he will balance his contradictory policy goals. And ordinary Americans, the people whose mortgages and credit cards and retirement accounts depend on getting this right, are largely in the dark about how all these forces interact. If you are making financial decisions right now, buying a home, refinancing a mortgage, investing for retirement, planning a business expansion, you are making those decisions in an environment of maximum uncertainty. The range of possible outcomes is wider than it has been in years. 3 cuts is possible. 2 cuts is possible. 1 cut is possible. 0 cuts is possible. And if the lame duck pattern holds, if inflation surprises to the upside, if the January data was a 1-month aberration rather than a trend, a rate hike is possible too. I am not a financial advisor and nothing I say should be taken as financial advice. But what I can tell you is that the confident predictions you are hearing from mainstream sources that rate cuts are coming, that relief is on the way, that the Fed will ease multiple times this year, are built on assumptions that may or may not hold. The data needs to confirm. The Fed chair transition needs to unfold. The Warsh policy combination needs to be implemented. The market needs to digest all of it. And any step along that path could produce surprises. The 43% probability of 3 or more cuts is significant. It shows momentum toward easing. But 43% is not a majority. It is less than a coin flip. And the 57% probability of fewer than 3 cuts includes scenarios where you get minimal relief or no relief at all. The next 90 days will tell us which scenario we are in. Powell's remaining 2 meetings, March 18th and April 29th, will reveal whether he follows the lame duck pattern of caution or breaks from it. The inflation data in February and March will show whether January was a trend or a blip. Warsh's confirmation process and early statements will signal how aggressively he intends to move, and all of it will be reflected in your borrowing costs, your investment returns, and your purchasing power. Subscribe to Market Acme right now because the next 3 months contain more uncertainty about monetary policy than any period in recent memory. The forces pushing toward cuts and the forces pushing toward caution are nearly balanced. The resolution of that balance will determine whether you get the rate relief you are hoping for, or whether you face another year of elevated borrowing costs with cuts that never seem to arrive. I am Kenzo John. This is Market Acme. I am not a financial advisor, but I will keep showing you the forces behind the headlines, the historical patterns that mainstream analysis ignores, and the contradictions that determine whether the narrative you are hearing matches the reality you are about to experience. The market says 43% odds of 3 or more cuts. History says lame duck Fed chairs lean toward raising rates, not cutting them. Some Fed officials are discussing hikes while others talk about several more cuts. The incoming chair wants to cut rates while shrinking the balance sheet, a combination with genuinely unpredictable effects. And somewhere in that collision of forces is the path that actually unfolds, the path that determines what you pay on your mortgage, what you earn on your savings, and what your retirement is worth. The only certainty right now is uncertainty, and in uncertainty, preparation matters more than prediction. Understand the forces, watch the data, and do not assume that the comfortable narrative about rate cuts coming to save the day is the only possibility. Because the historical pattern suggests it might be the less likely possibility, and the gap between what markets expect and what actually happens is where financial damage occurs. 90 days, 2 Powell meetings, 1 Fed chair transition, and the resolution of contradictions that will shape your financial life for the rest of the year. The countdown has started.